Hello everyone, Sheila Purim here with Franchise Wizards. And today I want to talk about something very important, which is the new GOP tax bill that was passed in December last year, December 2017. As you know, both chambers of Congress have passed the Republican tax overhaul bill. And as you all can imagine, this is something that definitely will affect the entire US economy, everybody in it, literally. But as we all also know, this bill leans heavily towards tax cuts for corporations and business owners. And that's why we're having this interview here. I invited to talk to us today, Mo Shaban. Thank you, Mo, for joining us.
Thank you.
Mo is a CPA. And maybe before we start the interview, I want to ask Mo to just talk briefly about his background. Could you please share with us, Mo?
Of course. I graduated from San Diego State University with an accounting degree, and in 1988, and started working public accounting in January of 1989, and I have been in public accounting ever since. I am a CPA licensed in the state of California, and that's about it.
Excellent. Mo, thank you very much again for joining us. And at Franchise Wizards, we help a lot of people become small business owners, franchise owners. And that's why I just want to help provide everybody information so you understand if you decide to become a small business owner or if you are already one, how does that new tax bill affect you as far as tax breaks and tax implications? So maybe we can start, Mo. Could you give us a general background on what was the rationale behind this new tax bill and what is that exactly doing?
Okay, thanks, Sheila. So basically the new tax law that passed on December 22nd, 2017 applies to 2018 tax years. So the tax return we're working on right now does not get affected by this new tax law. But basically what the GOP wanted to do is stimulate the economy and create job and growth and more revenue through lower taxation, basically. So if people are spending more money, even though that the tax rates are lower, they may contribute more money to the government as far as taxes. So basically what they did is they stimulated I call it mega large businesses, such as Fortune 500 companies. And what they're hoping that will happen is those Fortune 500 companies will hire more employees, will give raises, and will give dividends to their shareholders. Then in turn, those people will start spending money. They go to restaurants more, they travel more, they stay at hotels more, they buy the new phone, they do repairs on their house. And that's how it stimulates the smaller businesses or the smaller market businesses. So it's what's called basically trickle down. So basically the revenue just like floats down and helps mainly the big ones. The big ones spend money, then their employees, then it just goes down and down, and it eventually helps the small business.
Okay, so I think you are answering already my second question, which is who is most positively affected by the plan?
Initially, it would be the big business, but like I said, the trickle down process allows the small businesses to benefit because they end up getting the business from someone else, and now that there's more money in the economy, there's more spending. People tend to spend the money and help the small business as well.
Okay, and I know there is a lot of debate whether this is really a good or a bad tax bill, and there is a lot of debate as we know about the current president and their policies. I want to reiterate that this interview by no means is leaning towards being pro or con our current presidency. This is not really a political debate, but really trying to understand how that new tax bill that went in place and is effective now is really going to affect the business owners.
Right, Sheila, because most of my clients are small business owners and they really don't care about the political issues. They care about, how I'm going to save more money, how I'm going to pay less taxes,
exactly,
how I'm going to grow.
Yes, same on my side with everybody I work with. My next question then is, who is most negatively affected by this new plan?
Good point. Probably the most people that are negatively affected are the wage earners, the W-2 people. Because what happens is with this new tax law kicking in, they're going to start losing some deductions. In California, we got the state income tax section, or the state tax section of the Schedule A is going to get limited to 10,000. That includes like withholding tax, property tax, DMV tax. And so that area is getting limited.
So less deduction for the regular employee.
Exactly.
That's basically what that means.
Exactly. They're going to lose some of that deduction. The home mortgage, before it used to be that you were able to deduct the interest on $1 million. Now it's on 750,000. Lines of credit used to be 100,000. Now they're not deductible. So again, it's a shrinking of the deductions for the W-2 wage earners. Another area that the W-2 people were getting helped was, for example, I work for you and I buy something for my client. And you don't reimburse for that, but I look at it as a benefit because I get a new client, or I keep my big client. Well, they used to be deducted as a non-reimbursed business expense. Those are gone. So there's a lot of cuts that happened in this tax law that affect the W-2 wage earners, where it doesn't affect, or actually it benefits the self-employed or the S-Corp or the LLC, the small business.
Lots of changes, huh? Let's focus today on the small business owner, because that's definitely the big part of the population that we help through our businesses. So can you just detail a little more about how they are affected by the plan?
So one of the new tax laws that kicked in allows you, if you husband and wife married filing jointly, have an income of about $315,000. So that's the cap on this law. That if they have business income, whether it's through a sole proprietor, LLC, S-Corp, they could get a 20% tax deduction. So in an example, let's say you and your husband work on a business of your own. You have $100,000 net income. So let's say you had 200 gross minus 100 in expenses. You have 100 net. The law allows you to take a 20% deduction. So before you would pay tax on 100,000, now you pay tax on 80,000. So you get a 20% deduction. Now, over 315,000, some people could still take the benefit. CPAs, attorneys can't. So basically, if you're selling labor, you can't. If you're selling materials or food and stuff, you can. But it gets really complicated over 315,000 in income. But basically, if someone makes 150,000, married jointly, they'll get $30,000 deduction, basically 20% of that. So that will kick in 2018, which is basically now, but the tax return will be filed in April of 2019. But there's other laws that either got stronger or have been on the books for a while, such as home office, meal deduction, internet deduction, cell phone deduction, auto deduction, travel deduction, that the self-employed people or corporation or LLCs get, where a W-2 does not get a deduction. I mean, one of the great benefits is the retirement. You could do more retirement if you want to. You could hire your kids and put them on payroll and put money in a Roth IRA for their college, degree or college tuition. So there's tons of benefit that you can't get as a W-2 than you can as a
small business owner. And these benefits, all these tax deductions that were already in place before, they continue in place, right?
That is correct. The only one that went away is entertainment, and then there's things that you could do to kind of fill its place. But I would say 95% of the rules stayed or got stronger. And then we had the additional, the 20% one we talked about. That's a huge number.
20% is quite a lot.
Yeah, an area that got stronger is clients that have equipment. There's a code section called 179 that you had mentioned you wanted to hear about. And that's a really positive deduction you could take. And the funny part is you don't even have to pay for it. So I could go buy $100,000 worth of equipment in the first year. Let's say I have some other income that I could use it against, and take a $100,000 loan, which means I haven't paid for it yet, and then take a full $100,000 deduction if I have the income to zero out or reduce my taxes. So there's some great benefits.
So I can see that.
Got stronger. Yeah.
Yeah, I can see that working really well for someone investing in vending machines, for example, or a laundromat. There's another example where you buy a lot of dry cleaning.
Yeah.
Okay. Yeah, we do have franchises.
Have a lot of kitchen equipment, you know, people that have big trucks, because any truck that's truly used for business, and I'm not talking about the SUV law, but any truck that's used, let's say I have a towing business as a client, they could write off the whole tow truck in one shot. For example, that's $115,000.
Yes.
This law, the 179 law, even got stronger where the cap has increased. So before you could write off up to $500,000, now it's $1 million that you could write off in one shot, which is huge.
It's huge.
Yeah.
Oh wow! Can you tell, a lot of the people I work with, they're going to become a business owner for the very first time in their lives, so they don't know much about some of these deductions that, despite the new tax plan, they could deduct. Could you talk again about a few other areas? Just detail a little more.
So just a home office. So a piece of your, let's say you have a 3-bedroom house and one of your bedrooms is exclusively used for an office. So you could take a proration of your house, and let's say that room is 120 square feet, and the total place, let's say, is 1,200 square feet. So you could take a proration, even if you're renting, you don't have to own. You could take a home office deduction. For your utilities, for your water, cleaning, if you have a housekeeper, a prorated percentage of that. Trash, gardening, swimming pool cleaning. I mean, whatever you have, you could take a proration and use it. Your cell phone, your internet. Let's say, in your example, you go out to dinner with your husband and you talk about work. That's a business deduction. You go to a dinner with your attorney, with your CPA, with clients. That becomes a meal deduction. You travel, you drive around. Where as a W-2, you drive to work, it's not a deduction. And you drive back, it's not a deduction. But now, for you to drive to a couple different clients or go see your attorney, go see your CPA, go buy flowers for a client, all that becomes a deduction. What else? Charitable contribution kind of stayed the same. Retirement plans, you could put more money away if you are a self-employed person. Of course, you have to make the money, but you can do that. We talked about the equipment that you could write off.
Excellent.
So there's that could be an hour conversation just about.
Very nice.
So what I tell clients is, or potential clients is, go see a CPA, make sure they do planning, call me if you have questions, or email me, and I'll give you a list of stuff that you could deduct. I mean, it varies a little bit by business. So, for example, a business that doesn't have any equipment, doesn't worry about Code Section 179, they may in turn have heavy employees, or they may in turn have heavy costs. So there's other things that may affect them but I talked about the general ones, like cell phone. Everyone is talking on the phone with their clients. Everyone's on the internet. So those things are automatic, and you see amongst all types of businesses.
It's definitely worth using the help of a CPA, because there are so many small details on what potentially could be deducted that without appropriate help and counseling, you probably wouldn't take advantage of some of these different categories.
Definitely. And when you want to see a CPA is when you start, not after the tax year ends. So like right now, if a client comes to me and goes, Mo, it's January, let's say 31st, the end of this month, and what can I do for 2017? I don't have a ton of things I could advise him or her on. But let's say it's December and I'm going to say, hey, do you think you're going to need equipment? Oh, definitely the next 3 months I'm going to need this equipment, whatever it may be. So let's get it now. You don't have to pay for it. Let's
Yes,
get it now so I can get a deduction. Usually
that's great advice.
post-tax season advice is usually retirement, and it's, there isn't much because the year is ended. There isn't much I could do.
Yes.
But in October, November, December, when we do a ton of planning, that's when you want to meet with your CPA and say, hey, what should I be doing before the year ends? I have a
Definitely.
surprise net income of 200,000 last year at 100. What should I do to minimize my taxes?
Mo, I have another question for you regarding business entities. I know that people have a lot of questions about the differences between owning a LLC versus a corporation. Can you talk a little bit about the difference between those entities, and from a tax standpoint also, how do they differ?
Right. Well, you have a C Corp, which we probably don't, I may have one or two clients that are C Corp because they want to pick a different a year end. They want to be a fiscal rather than a calendar year end. But mainly it's either S-Corp, which is a small business corp, or a LLC.
Okay.
And then a lot of people are sole proprietors, which is it's just scheduled in their 1040 tax return. So with S-Corps and LLCs, they're both treated as a flow-through entity, which means the income flows into their 1040. They both pay a minimum franchise fee to the state of California, but they don't pay income tax. It's a flow-through, which means the tax is paid on the individual level. So in the past, we used to put people that own a business in an S-Corp and had real estate in an LLC. Now, for smaller businesses that are, let's say, husband and wife or a sole owner, we put them in an LLC because clients don't want to do payroll. And in an LLC, you don't have to do payroll. So for smaller businesses, for husband and wife or a sole owner, an LLC may be beneficial. I also have some clients that are foreign entity, like they're Canadians. They can't own an S-Corp. They have to be an LLC. S-Corps are great if you want to avoid some taxes as the income increases. So for example, in an S-Corp, you could draw a reasonable compensation, and then the difference could be treated as a distribution. The benefit about a distribution is you don't have to pay 15.3% Social Security and Medicare on it. So I could have a client that makes 200,000 net. We decide that his reasonable compensation is 80. So 80 of it, he would pay Social Security and Medicare on, just like an LLC. But on the 120, he just pays income tax on, which he could save, $10,000, $15,000. So it's really important as your clients start the business that they talk to a CPA or an attorney and see what's best for them before they create one. Now, of course, the LLC and a C Corp, an S Corp have a legal process or legal Zoom. There's an initial cost the first year they have to pay. And then after that, it's basically the franchise fee and the tax prep fee that they have to pay. So there's a little bit of additional expense, but it's a very correct direction to go, especially with the new tax law changes. That's what you want to be. You want to be an LLC or an S-Corp. And again, I just had a meeting, for example, with a client, and for them, an S-Corp was the right solution. It's funny that the person I didn't meet with and her partner, her husband is also going to be a client. And for him and his partner, an LLC may be the solution because they're not going to have employees. They're not going to grow it too big.
So it varies a lot by each situation. And in my case, I work with 500 franchises. So it varies so much because some businesses, you won't have any employees. They're owner operator. You can manage the business from your own home, while other businesses, you may require that over time, you're going to employ 100 people.
Exactly. So, I have a good example for you. So I have an LLC. It's an individual person. She doesn't want to make it bigger than it is. She's very comfortable making about 75 net a year after deductions and everything. And her reasonable compensation, if we had done an S-Corp, would be about 75, 80. So she wouldn't get any benefit there. So why should she do payroll and have that additional cost and the additional S-Corp headache that people may say there is. For her, an LLC, single member LLC is perfect. Now, for another
Yes.
person, like you said, has 5 or 6 employees, their net is $200,000 or $300,000. Hey, let's take advantage and save $10,000-15,000 by being an S-Corp.
Yeah, no, that's great information, Mo. Thank you so much for sharing that. I think we're getting ready to wrap up our interview. And maybe for some final comments, I think after hearing everything that you're saying, it does look like this new GOP tax bill overall incentivizes people to become business owners. Would you say that's a correct statement, right?
100%, yeah. Yes. The
Get out of corporate America.
Yeah, the deductions are there. There's additional benefit that kicked in because of the GOP tax bill. So now you even have more reason, if that makes sense, to be on your own, making your own money rather than working for someone.
Yes. Any other additional advice or insights, Mo, you would like to share with everybody watching this interview?
Again, I would say, have your new people go see a CPA tax attorney to pick their entity type, and then at the same time do tax planning before year end. Those are my 2 biggest advices.
Excellent. And I'm going to share here, just so everybody can see both my contact information as well as Mo's contact information. So in case you would like to talk to us about becoming a business owner, you would like advice with selecting the right business for your profile and preferences, and you would like to speak to Mo about your situation, what type of business entity you should open and how to optimize your tax deductions, definitely feel free to reach out to us. We are more than happy to help. Mo, definitely. Thank you again. Yeah.
Thank you, and have a wonderful day.
You too. Thank you so much. Bye-bye, everyone.
Bye-bye.